Nigeria's Monetary Policy Committee begins talks today, and joining us to discuss the possible outcomes is David Faulkner, South Africa and sub-Saharan Africa's economist at HSBC. David, thank you very much for joining us again. And David, I've seen your note, and clearly you are expecting further tightening here. But before we get into the tightening, let's talk about the exchange rate policy that you think may come out of this meeting. Clearly, Naira under pressure today. We're seeing it closer to 190 to the US dollar. Your thoughts about what the MPC is likely to do?
I think our view on exchange rate policy is that it will stay as it was at the last meeting. So we saw the shift, the devaluation of the official exchange rate, the widening of the band, and that obviously provides some additional flexibility within the exchange rate management that the central bank has. Our view, however, is that there will be a necessary additional monetary tightening that needs to come through at this meeting. Obviously, what we've seen ahead of the November MPC meeting seems to be repeating in many ways. We see ongoing stress on the Naira. We've seen it depreciate pretty significantly ahead of today and tomorrow's meeting, with it now sitting at just below 190. And I think that really is indicative of significant macro risks in the economy.
Right. But don't you think that they may tweak that band a little bit? Because when you look at what has happened since November, since the last meeting, I think everything that happened between September and November has probably happened between November and January. So I'm talking about a lower oil price. We're talking about even further weakness of the Naira. So don't you think that warrants a change in the exchange rate band? Of course, that is the official band. The interbank market still trades at a premium to that.
As our note has suggested, HSBC's view is that what is needed is further tightening, further monetary policy tightening. We think we've seen some sort of overshooting in the exchange rate to some extent in the near term. We believe there will be a gradual depreciation trend through the course of the year. But right now, what we see as important is further monetary policy tightening, further attempts to stem excess liquidity in the system, and attempts to stabilize the Naira through a higher MPR. At the moment, we see tomorrow's decision as being a 50 basis point hike, but we think more will have to be done and see the policy rate at 14% by the end of the quarter.
All right, so let's talk about that CRR that you're suggesting that they may take up as well. That obviously is going to put this economy under a little more stress. So you're talking about lending rates moving a lot higher. And we know that in the past, the central bank governor, of course, when he stepped in, has already made that case that he would like to see lower rates. But I guess the reality of the day make that difficult for him to achieve.
Certainly, I think the aim that the new governor outlined when he first stepped up to the position was very much one of a long-term view that lower lending rates, lower rates in the economy will be positive for growth in Nigeria. However, the reality is that we have a series of macro risks in the economy right now that mean that really loosening policy is just not on the cards. It's not an option. Right now, what is needed is more tightening, an attempt to stabilize the currency, to bring stability to the market, and that is really where the focus is right now.
Right. What about that inflation rate? We see it really steady at about 8%, and it's been steady for the last 2 years. Do you think this is the year that we may see it jump out of that 10% range?
I think our view is certainly that that is the danger looking ahead. We've been a little bit surprised by quite how stable inflation has been right at the end of 2014 with that 8% print in December. We see obviously that there's food price stability in there at the moment, but the risks really are the fact that we've had a pretty substantial depreciation of the currency, the devaluation of the official exchange rate means that imports are now subject to a much higher exchange rate than they were previously, and that's really going to feed through into prices over the course of the next few months. HSBC's view is that we will see prices creep steadily higher, moving towards that double-digit level. We're not quite forecasting a breach of 10% yet, but we do see it substantially higher than we've seen it in the last 2 years.
Right. I just want to focus on that view that you think we will see a gradual depreciation of the Naira, because many will argue, especially when you look at the news flow around JP Morgan's warning around Nigeria's inclusion in its emerging market bond index, if the government does not improve, or rather if the central bank does not improve liquidity, there is a real risk that Nigeria will come out of that. And what that means, of course, is that people who are invested in those bonds will get out of those bonds, and that could put even further pressure on the exchange rate. So your thoughts about that point?
It certainly is a danger right now. The view of HSBC is that this gradual depreciation reflects a series of potential shocks that may well occur through the course of the year and that will put pressure on the Naira during 2015, one of which is the current stresses attached to a lower oil price. However, the view of HSBC is that we should see some recovery in the oil price later on in the year. A second is really around the elections that take place next month and the risks they present to capital flows. And finally, it's really around US monetary policy, what is happening to global policy rates and what that means for dollar liquidity and also capital flows and currencies.
Right. I think there is a real risk that this could be the year where we would not see, especially relatively, very, very low flows into Nigeria's fixed income and equity market, given the exchange rate scenario that you have pointed out here. So if that doesn't happen, though, isn't it a self-fulfilling situation where the exchange rate just gets worse? Because over the last few years, we've actually come to depend on those flows a lot to keep the exchange rate stable.
It's certainly a risk. The world we're in is certainly evolving. With an oil price at between $45 and $50, it's a very different world that Nigeria lives in than when the oil price was above $100 a barrel. As I've mentioned, our house view, our HSBC view is that we will see some recovery in oil prices. That should help with to some extent with assisting a recovery on foreign exchange flows into the country, and that too could provide somewhat of an offset to these other myriad of risks that exist right now.
All right, let's talk about options, because it's certainly coming. The pressure on the Naira is here, and we're seeing it again today. What else can the MPC do? Is there anything new you think they can throw out there in terms of policy to keep the exchange rate stable?
What we've seen in the past, I think, is the broad series of options that are on the table right now. It will be a case, our view is that it will be a tightening on a number of those potential pillars, particularly the monetary policy rate, possibly the cash reserve requirements on private deposits. Beyond that, we've seen a lot of administrative measures to try and induce stability to the foreign exchange market. Those haven't seemed to have been particularly effective right now, raising some obvious concerns around liquidity. So that's where we see the monetary policy response. What we've seen with Budget 2015 is that there has been somewhat of a fiscal response, but with oil at a lower level right now, arguably there is a need for an even greater clampdown in terms of the budget, perhaps a greater investigation into increasing non-oil revenues beyond what is outlined in Budget 2015, because in reality, there's very much a case of monetary policy and fiscal policy going hand in hand. There's been a lot of statements within the MPC around the importance of rebuilding fiscal buffers, and that links very closely to what is going on with the excess crude account, what is going on with the budget oil price, and what is going on with the actual oil price, because that will determine the flows into the ECA and providing some scope or some enhanced scope for the CBN to intervene more aggressively in the currency market.
All right, David, let's leave it there. Thank you for those insights. We'll, of course, be watching that announcement tomorrow. David Faulkner, South Africa and sub-Saharan Africa Economist at HSBC.